Hi, everybody. It's Dr. Robinson. It is the December 10th, 2022 meeting of the Money Masters Investment Club. So we're going to get right to it today and talk about what's going on in the last week and what we think is going on in the economy and in the markets in the days and weeks to come. Let's go ahead and get started. As usual, our itinerary deals with primarily two things. So we're going to look at our financials and we'll do a little bit of a market update. As far as the financials go, you'll notice that we started last week on 12/3/2022 at 23.84. Our gains and losses for the week, 34 cents. Ending NAV was $24.18. So for the week, we gained about 1.4%. It doesn't sound like much. I will tell you this. Um, been working on some charts to help us deal with the volatility. I kind of explained to you last week about the volatility. The volatility has been horrible. It has not changed much in the last week or so. In fact, if anything, it's probably gotten more volatile. We don't normally like volatility, and I do, and the VIX has started coming back up again, which is a good thing to me. But while we're trying to get our way through or make our way through this volatility, I had kind of reduced the number of options contracts I was purchasing. Traditionally or typically, I buy a minimum of 1,000 contracts, sometimes a little bit more. Um, but when I'm nervous about the markets or when the market is changing so fast that I can't keep up with it, I drop that down to 100 contracts. So we actually had a pretty good week this week. Pretty good returns. On one day this week, we made $2.73. Of course, on those kinds of days, we wish we had, or I wish I had been trading 1,000 contracts. That would have been almost $300,000 in gains just for a particular day. But because of the volatility, I've only been doing 100 contracts just to kind of keep things safe. I've worked out some math on how to deal with some strangles in the event that we get on the wrong side of a trade, which we did a couple of times last week. But I think we've kind of got that one knocked out too. So this week, or going into next week, I should say, we're probably going to go back to the thousand contracts at a time. I think we've got enough security or enough strategies in place to kind of help us with the volatility if it wants to spike or make those candles, as I showed you last week. If those candles get long and looks like we're underwater for any length of time, we've got some ways to handle that now, I think, that are going to be successful. So expect to see some better returns next week. Expect to see more volatility in our net asset value too, though. I do want to remind you, not every trade is successful. So sometimes most of the time, about 94, 95% of the time, we're right. There is a percentage of the time we're wrong. When we're wrong, we try to limit those losses, but in any event, expect to see a little bit more volatility, but that should result in some higher gains. In addition to the numbers I just gave you, we do still have some unrealized gains that we're kind of holding. These are on the money that we're not playing with directly in the market on a day-to-day basis, simply because we can't do it. There's too much money there. Our strangle remains, so we do have our strangle, of course, and whatever strangle remains positive. The calls are in the money by $1.89. The puts are in the money by $1.01. So both sides of our trade are actually in the money right now, which is a good thing. Net unrealized gain right now has grown to 291,000, so just under $300,000 in terms of an unrealized gain. This is going to change in the coming days. Well, we've got the end of the year coming up. We got to make some changes. We're going to have to. I do have some people that are going to be taking money out. They've already told me ahead of time. Remember, I told everybody you got to give me typically 30 days advance notice to take money out so that we can deal with this. So I do have some of that coming up, and so I will be taking some of this money out for redemptions. People, buy Christmas gifts and stuff. But in any event, this number will change in our next meeting. But overall, still doing pretty well on the strangle we've been holding for quite some time now. This chart is our traditional chart. We've been looking at interest rates for quite some time now. I did something different this week, though. I added, because I got to tell you, for the first time in my memory, and I can't remember how far back this would go, but for the first time ever, we are inverted on every single bond in the U.S. Treasury system. So you guys know that the short bonds, we call them T-bills. T stands for Treasury. So Treasury bills, there are four types of Treasury bills. And they do it by week. So there's a 4-week bill, a 13-week, a 26-week bill, and then of course the 1-year bill. I put it here as a 1-year Treasury, but technically it's a 52-week Treasury. But in any event, you'll notice, first thing I want you to draw attention to is the upper left-hand corner. That's the Fed funds rate. That's the interest rate that the Fed has been playing with over the last few months, actually almost a year now, that they've been moving interest rates higher. So the Fed funds rate is 3.83%. Now remember, this is the overnight rate that banks charge each other. So this has nothing to do with interest rates that you and I would pay with credit cards or anything. This is just a bank rate. But that bank rate, the Fed funds rate, 3.83%, is higher than the 10-year Treasury. It is actually higher than the 30-year Treasury. I don't remember a time in my life where this has occurred. Now, it may have been, I just maybe wasn't paying attention to it at the time, but I can't recall, and I don't really have time to do the research on it to find out how far back we'd have to see the last time we saw the Fed funds rate in excess over the 30-year rate, but it's been a long time if it's ever happened. But look at the other rates too. These other short bills, the 13-week bill, 4.3%. That's over the 10-year. The 26-week bill, 4.73. That's over the 10-year bill. The 1-year Treasury, and again, the ones we've normally been tracking, the 1-year, the 2-year, the 3-year, all of these bond rates are above the 10 and even the 30-year rate. This is remarkable. Now, this is the bond market telling us there's a recession coming. I've told you before, I've been saying it for a long time. When the yield curve inverts, a recession is coming. So we know one's coming. I still maintain for the moment. Now there might be some clouds on the horizon that might make my mind change in the coming months. But for the moment, I still maintain I think it's going to be a relatively long recession, but not a very deep one. So I don't think it's going to be a very bad recession, although I think it might last longer than a traditional recession, which lasts usually no more than, say, three quarters. Sometimes it goes on to a full year, but in most cases, most recessions last between 2 and 3 quarters for a year, or just under a year. I think this one might be a little bit different. But it's remarkable to see all of these rates inverted. Our entire, basically, Treasury rates, every single one is inverted. It's just remarkable to see. You'll notice that, by the way, that some of the ones that we do traditionally follow, the 1-year through the 30-year bonds, I keep track of the basis points over there on the right. So we've seen increases in each of those as well. So they're up not much from our last meeting on 12/3. So the 1-year Treasury moved up 3.5 basis points. That's not a lot. We saw 5.8 on the 2 and 10 basis points on the 3-year. On the 5-year, it went up 11.3 bips. So overall, interest rates did increase a little bit. That means bond prices went down just a little bit. Some of it was from the PPI number we got this week. I'm not going to talk too much about the PPI number. It wasn't that remarkable to me. The PPI number did come in a little bit hotter than expected, by the way, and that's a bad thing. That means inflation kind of rose again, but it was only 0.2 worth. The market did on Friday kind of significantly decline from that, or was it Thursday? I forget now whether it was Thursday or Friday, but the market did significantly decline, especially in the futures. The overall market tried to get some of those gains back, and they did get some of the gains back, but they didn't get them all back. But we have another number coming out. We have another inflation number coming out next week, along with the Fed meeting. The Fed meeting, of course, is going to be more important. That meeting is on Wednesday. So they meet Tuesdays and Wednesdays, and then Wednesday they make their announcement at 2 p.m. So we will be out of the market. I know that there are some people thinking about doing a strangle or a straddle before the Fed does their announcement. Might be a good time to do that. But in any event, expect a lot of volatility. I still expect the Fed to do 50 basis points. I don't think that the PPI number being, and it was only, I believe it was 0.2 higher than what we expected. So it's not like it was material. Although, if you remember a few weeks ago when the CPI number came in 0.2 lower, the market exploded higher. So it might be one of those things where good news is bad news again type of thing, and bad news is good news. So we expect the 50 basis points. I don't think that this increase in the PPI is going to have a material effect on what the Fed does on Wednesday of this week. So I still think it's 50 basis points. Although I will caution you this, we do have a CPI number coming out, which is the consumer price index. That's the inflation that you and I pay. Remember, the PPI is producer prices. That's the prices or the cost for raw materials for companies like General Motors to, they buy a lot of steel and aluminum and all the things that they make or buy to make cars. So their costs have gone up a little bit, but the CPI is the prices that you and I pay when it comes to things like groceries and fuel or and stuff like that, but refrigerators and appliances and stuff. So remember, as producer prices come up, they pass those prices on to us. So the amount of money we have to pay to buy a car or to buy a refrigerator or something generally goes up. If the CPI number comes in significantly higher this week, and I think CPI, and I don't have that in front of me, CPI I think comes out on Monday. But if that number comes out significantly higher than what we think, if it comes up in more than 0.2, maybe if it comes up something like 4 or 0.5, that might mean that the Fed might have to do the 75 basis points on Wednesday. I don't see it though. I think the CPI number is actually going to come in a little bit pretty steady. I wouldn't expect any more than 0.2 above what some people might expect. So look out for that on Monday. We are seeing some higher prices on food. Food has been getting higher lately, and I'm not entirely sure why. And I saw that in my own personal life. I eat a lot of eggs, and a few weeks ago I was buying eggs, and they were only costing me, for like a pack of 18, they were running me $2.34, and I bought some yesterday, and they were $6.56. I don't know what's going on with eggs. I don't know if it's just the cost of chickens or if there's been bird flu or something. It's been wiping out chicken populations or something. But the cost of eggs has gone up in the last month fairly significantly. I heard or I read somewhere that it was about 38% just in the last 30 days. So that's a big increase. Whether that's going to show up in the CPI, I don't know. Remember, CPI looks at a lot of different things, not just food. There's energy costs and things of that nature as well. So energy costs have been coming down a little bit. Gas has come down quite a bit. So that might help bleed off some of the steam. But in any event, we will see that number on Monday. And if it comes in significantly higher than what we expect, then the Fed may have to do 75 basis points, but I don't expect that. So I expect right now to see a 50 basis points increase in the Fed funds rate. By the way, you'll know the Fed funds rate right now is, as you see on the screen there, 3.83. If they raise it 50 basis points, that takes the Fed funds rate to 4.33. So it's important to remember that these rates, even though a lot of people are like, oh, the Fed's going to kind of pivot and rates are going to kind of get steady here, we're still going to be looking at a Fed funds rate of 4.33 if they do the 50 basis points. That's going to take mortgage rates quite a bit higher. It's going to take car loans and all these other types of loans higher. We're starting to see increases in people not making their credit card payments. It's up by about 30% in the last 6 weeks or so. Now, it's still a relatively small number. It's below historic norms, but it is increasing. So it is a concern because credit cards are one of the first things to get hit when Fed funds rate goes up. Banks start charging more for interest rates on credit cards because that's it's kind of the low-hanging fruit for banks. So interest rates on credit cards will typically go up a little bit. Something else about this that's important to understand too. We always look at the inversion rates. What's the difference between a 2-year, for example, which is our The traditional bond that we look at in terms of what the economics of the economy are doing right now versus the 10-year, which is our standard. So normally we expect the 10-year bond, of course, to have a higher interest rate than the 2-year bond. But right now, as you can see from the screen, it's inverted. The 2-year Treasury is at 4.342, the 10 years at 3.586. It's upside down, but it's not upside down by a little bit either. It's 76 basis points. So the 210 bond yield, or the spread that we like to look at in economics, is inverted at one of the steepest that it's been in a very long time. Normally, when it inverts, it only inverts by 10, 15, maybe 20 basis points. 76 basis points is pretty stiff. Something even worse. Look at the 110, the 1 year versus the 10-year. The 1 year is at 4.722 versus the 10-year at 3.586. That's 110 basis points. So that one's even worse. So at 110 basis points inversion on the 110 bonds is, again, a really good sign that a recession is on the way, and we're getting closer and closer and closer to it. So it's time to kind of batten down the hatches a little bit. You need to kind of get conservative in um, spending money, that type of thing. And I don't mean to not spend money at all, but traditionally, when we go into recessions, we need to batten down the hatches a little bit and kind of exclude unnecessary spending and all that sort of thing, just to be safe on through what might happen, or how, depending on how long the recession could be. But I do think that we're getting closer and closer to the actual start of a recession here. So it's important to batten down the hatches a little bit. Something else that's on the horizon, and again, we expect this kind of stuff to happen in recessions. Now, this is on the European side, and most of you, I don't know anybody in the club that probably has any money in the foreign markets. But if you do, and if that foreign market happens to be Italy, you've got to get your money out of Italy. Italian banks, for all intents and purposes right now, are insolvent. They don't have the money to continue. Now the European Union is going to try to bail them out as much as they can, but you can see that it's not just Italy. Now this by the way comes from the ECB when it comes to which countries are having, are doing okay financially. Of course, on the left hand side you see Germany. Now Germany, the symbol for Germany is actually DE for Deutschland. Germany's got $1.23 trillion in assets over their liability, so they're doing well. So is kind of strange Luxembourg. That's the LU down there. Luxembourg's at $303 billion of trade surpluses, so they're doing well. And so there's other countries there, Netherlands and some other countries there that have smaller surpluses. When you go to the right side of the chart here, you start looking at imbalances here, and you look at places like Greece. The ECB, by the way, you'll notice the ECB down there. Now that's the equivalent of our Fed, but the ECB is actually upside down in their finances as well. So the ECB is about $339 billion in the hole. Now again, they're the ECB, so they can print money if they need to. They can print euros, so they can solve that problem. But again, just printing money doesn't solve problems. It actually causes inflation. So they're facing some higher inflation there potentially if the ECB has to start printing money to kind of solve their imbalances. But really, the biggest here, Estonia and Italy are bad. Greece is pretty bad. Greece isn't as bad as it was a few years ago. But what I am saying here, and the reason I put this slide on, and I don't follow too much of the European stuff because they live in a world of their own. But if you do have any money, I do have some other clients on my paid side that have money in European bonds, especially in the Italian bond market. Rates are going up there. They're going to continue to go up pretty high. The ECB is trying to keep them artificially low right now, but that's what's caused the ECB itself to go into the hole. They're trying real hard to keep Greece and Italy out of trouble. I think ultimately it's going to fail, but effectively the Italian banks have become effectively insolvent. So if you have money in an Italian bank, you need to get it out. You're going to lose some money on the translation from the currency translation from euros over to American dollars, assuming that you're going to put it back in the United States. But you do have to get it out of Italy. Money in Italian banks right now is a risk that is just too great. One other thing in terms of something we see in the economy, the Bank of International Settlements came out with their just a statement talking about U.S. mortgage-backed securities. Now, if you don't know what a mortgage-backed security is, it's just simply a bond that's put out by the Treasury, but it's backed by mortgages. Now, traditionally, those are very safe because they're backed by backed by mortgages. But what happens here is whenever a bank does a mortgage, banks only have a limited amount of money that they can lend in mortgages and things because they're not governments. They can't print money. So if a bank runs into trouble with running out of money to lend in mortgages, well, the government doesn't want them to not make mortgages. So what happens here is the government sets up these government-sponsored enterprises. They're called GSEs, and you've heard of them. Think places like Fannie Mae and Freddie Mac and Ginnie Mae. So those institutions are designed to buy those bonds, or buy those mortgages rather, from the banks, and then they package them up into bonds. Now, if you think about it, it's a really pretty simple process. And let me just kind of use some simple numbers here. Let's say Bank of America issues $1 billion worth of bonds. Well, if they issue $1 billion worth of bonds, and I said bonds, and I meant mortgages rather. So if they issue $1 billion worth of mortgages, then what's going to happen here is they're going to sell those mortgages to Ginnie Mae, Freddie Mac, Fannie Mae, whoever it may be, depending on what kind of mortgage it is. They each buy different kinds of mortgages, by the way. We're not going to worry about that. But in any event, what happens here is that Ginnie Mae, Freddie Mac, and Fannie Mae, they convert those bonds or those mortgages rather, into bonds. And you know that a bond has a par value of $1,000. So if you have $1 billion and you divide that by, let's say, $1,000, and I can't do that math in my head, I guess that'd be what, 1,000 bonds, or 1,000,000 bonds rather. So what they're doing is they're converting 1,000,000 more, all of that $1 billion of mortgages into, let's say, 1,000,000 bonds. And a bond has $1,000 par value. And then they sell those bonds to investors in the marketplace. And they're actually pretty good bonds in general because they're backed by mortgages, so they're safe because most people make their mortgage payments. But they also have a little bit higher yield than a traditional treasury from the government. We just looked at the 10-year treasury at 3.5%. So these bonds might have an interest, because they're mortgage backed, and interest rates right now are in the sixes. So if you were to buy one of these bonds, you might have an interest rate, and it's not going to be 6 because it's spread out over a long period of time, but it might be 4, 4.5, 4.75. Well, that's a better rate than you would get from the Treasury. Now, it does come with additional risk, though, or some risk that you don't have with the Treasuries themselves, because remember, Treasuries are backed by the full faith and credit of the United States government. Mortgage-backed securities are not unless they're Ginnie Mae bonds. Ginnie Mae bonds are, so they're still safe. But the Freddie Mac and the Fannie Mae, those aren't backed. So what happens here is as investors start buying those or buy those, when recessions come in, a lot of people stop making house payments. We saw this in 2008 when we went through the financial crisis, especially in places like California and Nevada, out on the West Coast where house prices are so high. Well, when they start making or stop making payments, the value of those properties go down just simply because there's somebody's defaulted on the mortgage, and banks have to write that stuff off. So as banks start writing that stuff off, these mortgage-backed securities become more volatile. So as the volatility increases, you start to see fewer and fewer people making all their payments. Now, I'm not talking about lots and lots of people not making their payments. Even at the height of the financial crisis in 2008, only 7% of Americans didn't make their home mortgage payments. But remember, banks normally only expect about 1% of people to default on a mortgage. When you go from 1% expectation to 7% real or actual, that's a huge impact to the banks. And we saw what happened to the banks in 2008. They nearly went belly up. So what happens here is as these interest rate spreads between, so a 2-year bond, the 10-year bond, and all this stuff, as they start to spread, more and more of those mortgage-backed securities become more volatile. Spreads widen, they become more volatile. So a couple of things have happened in recent past or in the last few months because interest rates have been going up. The big investors in mortgage-backed securities have basically bailed. They don't want to buy them because they can get better rates somewhere else. Safer rates, by the way, too. So they can get better and safer rates in other places. So why go out and buy a mortgage-backed security that might have a 4% rate on it when you can buy a 6-month treasury that's fully insured by the government for 4.7%? So it's a better place to buy it on the treasury than it is in the mortgage-backed security. So the bigger players have kind of moved on to something else. That only leaves the smaller investors, and it leaves leveraged hedge funds buying these things. Now, there's still billions of dollars going into these things, possibly even trillions of dollars. Who knows? But when prices or when the spreads start to widen and prices start to come down, they're the ones who are going to be the first ones to bail, especially the hedge funds. So they're going to bail from that market. That's going to cause a liquidity crisis, and that's what the Bureau of International Settlements was talking about. If the interest rates start to become more volatile here, if the Fed keeps pushing higher interest rates on the Fed funds rate, more volatility is going to come into this marketplace, and the risk to the system, and it is a systemic risk, the risk to the system becomes even more dangerous. And it could potentially cause, and I'm not going to say it's another 2008, it's not going to be anything like that, but it could be something fairly severe, mostly because in 2008 we had similar problem, but the Fed did back up Fannie, Freddie. They have to back up Ginnie, but they didn't legally have to back up Fannie and Freddie, but they did. This time around, they can't. They can't because they've got this policy where they're trying to force interest rates higher, so they're actually taking money out of the system. So the liquidity is actually getting worse because of what the Fed's doing. So if we see these rates or these spreads continue to widen, expect to see more volatility in the mortgage-backed market, and that volatility becomes even worse once the hedge funds and the smaller investors realize that they're taking on a lot of risk for relatively little gain. They start selling. Once they start selling, it becomes what we call in finance a falling knife. And you don't try to catch a falling knife. You let if a knife is falling, you let it hit the floor first, and then you try to pick it back up. You don't try to catch it while it's on the way down. And that's what a mortgage-backed security is in these liquidity crises. What happens is these things start to fall in value, but nobody comes in. Remember, to sell something, you have to have a buyer. So if you have a hedge fund here, or a hedge fund has a position here in a mortgage-backed security, the only way for them to get out of that position is for somebody else to buy it. But again, if a crisis is happening, nobody's going to buy it. There's no buyers coming in. The buyers are simply saying, no, we're not going to buy it right now, even though the price is a good price. Maybe it started at, and I'll just keep it simple, maybe the price of this thing started at $1, and now it's down to 75 cents. So somebody's lost 25% of the value of this thing. And you'd think that, buying something at 25% off or a discount would be a good thing. But a buyer comes in and says, well, man, if it's 25% now, it might be 50% tomorrow. So I'm not going to buy it today. So the price again continues to fall. And then tomorrow, maybe it's down to 50%. And then that same person says, well, man, it just went from 75% or 25% discount to 50% discount. And now maybe tomorrow it could be a 75% discount. Maybe I can buy this thing for $25 and it's a $100 investment. You don't try to catch it until it falls. As this continues to happen, it causes a liquidity crisis even with the big banks. So having said all of that, there's one other recommendation I want to make for you guys for the day before we're done, and that is, let me turn it here. If you're in mortgage-backed securities, now I don't think any of you may be. I do have some clients who I tried to get them out of the mortgage-backed securities earlier this year. Some are still holding. I've sent notices out to them. I think they've got to get rid of those positions. If you are in a mortgage-backed security, whether it's Fannie Mae, Freddie Mac, you should seriously consider selling, and certainly not buying anything. If you're contemplating buying more, I would say don't buy more. Now, Ginnie Mae, as you'll notice, Ginnie Mae is backed by the full faith and credit of the United States Treasury, so there's very little risk here, unless, of course, the Fed comes in and says, we're bankrupt, we don't have anything to do, which is really unlikely. But so Ginnie Mae, I think, would be okay if you're holding Ginnie Mae securities, you would be okay. But if you're holding Fannie or Freddie, you got to get out. I also, if you'll notice on the slide here, I also included Sallie Mae. Now, Sallie Mae is the student loan program. It's not a mortgage-backed security. But with the liquidity crisis in the mortgage-backed security, which is safer than Sallie Mae, because Sallie Mae has no backing other than basically students paying their loans, and students right now aren't paying their loans. Joe Biden has given them a chance to not pay their loans back. So if you're in Sallie Mae, I would treat Sallie Mae effectively no differently than Fannie or Freddie. Even though they're completely, I don't want to make it sound like they're the same kinds of investments. They're not. Student loans versus mortgages are completely different things. However, if Fannie and Freddie are going to fall, it's a pretty sure bet that Sallie Mae is going to do the same. So if you're in those kinds of securities, I would consider getting out of those fairly quickly. You should also avoid any kind of closed-end mutual funds, especially those with exposure to mortgage-backed securities and/or short-term repos. Now, repos are where the banks have a relationship with the Federal Reserve. Remember, there's two types of repos. There's a forward repo. We just call it a repo. A repo, the official name for a repo, by the way, is a repurchase agreement. But a repurchase agreement is where the Fed comes in and they want to increase the money supply to a bank. What they do is they buy securities from the bank. So all banks hold securities, government bonds, if you will. So when the Fed comes to a bank and says, "Hey, Bank of America, how much money are you holding in, or how many government bonds are you holding?" And Bank of America might come along and say, "Well, we're holding $500 billion worth of government securities." And so the Treasury comes in and buys those from the bank. The reason they do that is to increase the money supply. What happens here is if the Fed is going to buy securities from the bank, then the bank is going to obviously receive the cash for those securities. That cash goes into their account, and now they have more money to lend. That's how they increase the money supply. Well, the opposite of this is called a reverse repo. So what happens there is when the Fed is trying to tighten the money supply, which is what they're doing now, they're not buying bonds from the banks. They're selling bonds to the banks. So they're going to Bank of America and say, "Hey, Bank of America, we want you to buy $100 billion worth of bonds." And Bank of America says, "Well, listen, if we buy $100 billion worth of bonds from you, that's going to be $100 billion less money we have to lend to people for mortgages and cars and houses." And the Fed says, "That's the point. We're trying to decrease the money supply. We want interest rates to go up. And the way to make interest rates to go up is to decrease the money supply." So as the Fed continues to decrease the money supply with the banks, interest rates are going to creep up, and more stress comes into the mortgage-backed industry. So the Fed is actually kind of causing this to some extent, but right now they've simply said we're going to risk it because we've got to get inflation under control. And I've been saying this for months. They've boxed themselves into a corner. Normally, when you get yourself into a position where interest rates are so inverted that we know a recession's coming, the Fed starts to loosen the money supply. They start pumping money into the markets through the repo market. But when they do the reverse repo at the same time you're facing a recession, that's an anomaly. We've not seen that before. The Fed's never done that before, and I've told you this is brand new territory for the Fed. Nobody knows if this is going to work, and the Fed's got their fingers crossed. And everybody keeps talking about how they think the Fed's going to manage a soft landing. I don't see it. But at the end of the day, maybe they pull it off. By some grace of God, somehow they pull it off. It's possible. I don't see it. But just in case, we've got to be prepared. So no Fannie, no Freddie Mac securities, no mortgage-backed securities. If you want to go with Ginnie Mae, just for the yield, it would be okay. They are backed, but expect some stress in the system. So again, you might see some spikes in prices and decreases in prices, by the way. Avoid the mutual funds, especially those backed with mortgage-backed securities or repos, because those can decline rapidly. Also, avoid any kind of what's called an MREIT. Now, you guys know a REIT stands for Real Estate Investment Trust. When there's an M in front of the R there, that's called a mortgage REIT. Mortgage REITs, again, those are part of this problem here. Mortgage REITs are actually funded by these mortgage-backed securities, so they're directly hit by what might happen in the mortgage-backed community or investment product portfolio. So be careful there. Now, I'm not saying all REITs are bad. Just remember, if you're thinking about a REIT or if you're in a REIT, um, it's okay as long as it's not funded by mortgage-backed securities. So make sure that the assets that are in the REIT are actual real assets. And what I mean by that, when a REIT forms, basically a REIT is very similar to a mutual fund. It's not, by the way, it's not technically a mutual fund, but it's very similar to a mutual fund in that they accumulate or they bring in a lot of money from different investors and they go out and buy real estate. So if you're going to go out and buy real estate, that's good because that's backed by real estate. And unless real estate values start to come down dramatically, the REITs are doing okay. Now they are losing a little bit of money now because investment properties are coming down, but at the end of the day, that's just the normal economic cycle. But if it's a REIT that's where they're investing in mortgages, different story altogether. Have to stay out of those. So if you're in a REIT or you're thinking about a REIT, make sure it's a REIT that's actually investing in real property, buildings, and whatever it may be, office buildings, apartment complexes, hospitals, or whatever it may be. Make sure it's an actual property. But if you're investing in a REIT that's doing mortgages, different story, and I would stay away from those right now. Right. Other than that, I only have one other slide for the day, guys, for the week. I told you last week, once a month we'll go to a live meeting. So I kind of looked at the calendar, and I know it's a weird day. It's December 24th. It's Christmas Eve. But Christmas Eve, it's going to be the best time to fit my schedule. So on 12/24, instead of me putting out the meeting like I'm doing now, the video, we're just going to do a live meeting. We'll talk about all the things that we normally talk about, but I'm also going to do a little training. I told you one of the things that people have asked me to do is kind of do the training on the in the meetings. So we're going to learn how to hedge, specifically hedge a long position. I thought this would be a good training vehicle simply because we are getting closer and closer to dipping our toe into the market. Now, I'm not yet ready. I keep saying I think I'm getting ready, but then something bad happens and the market tanks again, and that's what's happened in the last week or so. So I keep hedging a little bit, and talking about hedging, I'm hedging that decision because what I don't want to do is I don't want to tell everybody it's time to get back into the market on in a particular stock or maybe in an ETF or something, and then have that thing come down in value. But what I want to prepare you for is, let's say we decide to go back into the stock market. Let's say we buy some energy stocks, maybe some Exxon Mobil or something. So if we decide to do something like that, there's always that possibility the stock could decline. And what we want to do is we want to learn how to hedge it so that in the event that it declines and even declines significantly, that we have an out, and so we don't lose money. Of course, the whole point of investing is not to lose money. We want to grow our money, but we also want to avoid losing any money. So we'll talk about how to do that when you go into a long position. It's not a terribly complicated thing. I can do that I can teach that in about half an hour or so. So we'll talk about hedging a long position next week or next 2 weeks or whatever it is. And then maybe another month from now, maybe we'll talk about how to hedge a short position. Although I'm not a big fan of hedging short positions because short positions shouldn't be held for very long. But anyway, we'll do a meeting on 12/24. That'll be live, 10 a.m. That's a Saturday. I hope I looked at that right. But 12/24 is a Saturday at 10 a.m. We'll do our normal meeting, and we'll do a little bit of training on how to hedge a position. If you guys have any other ideas about things you want me to teach, let me know. I'll always looking for ideas and stuff. So if you want me to something else out there you want me to teach, I can do that. I was thinking about maybe how to do a strangle. That might be another good topic for another day. But how to strangle a trade, especially in what we do with options, strangling can be important. So we'll look at how to do that. Other than that, guys, we had a pretty good week. Looking to have a better week next week. I'm going to get back to full-time trading with the normal amount of contracts. I think we've got the charts whipped right for the moment. So other than that, enjoy your weekend, and we'll see you guys. For those of you on the calls on the daily, we'll see you on Monday, and for those of the rest of you, we'll see you next Friday or Saturday. Have a good weekend.